We all know Nvidia is a beast that's absolutely been on a rampage. In today's stock analysis of Nvidia, I'm also going to share some concerns I have for investors to consider going forward. So first we'll start out looking backwards, then we'll look at the financials and current valuation, then we'll finish up looking forward at some of the concerns. Before we get into the results of the most recent quarter, I just have to say that I love Nvidia, both the stock and the products, and I've been in and out of Nvidia stock a few times over the last few years. I'm currently in a series evaluating chip makers, and we just wrapped up a very thorough 4-video series on AMD, one of which compares AMD to Nvidia and Intel. So if you're interested, please check out the link up here and down in the description. The 2-year chart here shows us what everybody already knows about Nvidia. It grows, it innovates, it makes frankly disgusting amounts of cash and free cash flows, and it probably isn't going to stop anytime soon. We're currently sitting up around 620 bucks, though that could change soon if the 4-to-1 stock split ends up going through in the coming days, and I'll share more about that in a minute here. Taking a quick look at the first quarter results, Nvidia once again destroyed expectations with huge beats. Revenues were up 84% year over year to 5.66 billion, which leads to a gross profit growth of 81% up to 3.6 billion. Nvidia's leadership under Jensen Huang has always been really solid and conservative, and you see that reflected in these operating expenses, though they are continuing to push the envelope with growing R&D budget shown here. Moving down, we see that income from operations has basically doubled to 1.95 billion, which carries us up to a net income that's up 108%. The balance sheet paints a similarly exemplary picture. While we don't see a particularly massive stockpile of cash and cash equivalents up here, we do see that Nvidia are buying stocks and bonds regularly, as reflected here under marketable securities. That's safe to consider basically cash equivalent, but just a bit more volatile. We see here from the cash flow statement that their purchases of marketable securities jumped massively year over year from 87 million for the first quarter last year up to 4.4 billion for this quarter. I wonder how much of that is going into Bitcoin. No, I'm just playing lol. Comparing current assets to current liabilities gives us a current ratio of 4.5. Goes without saying that that's super solid. And that's even improved from last quarter's 4.1-ish. Both short-term and long-term debt haven't changed this quarter. Now, breaking down their earnings into different sectors can give us a bit more insight to how things are going. By far, the largest portion of the business is gaming. Then we get data center, followed by professional visualization, then auto and OEM. The elephant in the room that everybody's thinking about is just how much of gaming actually can be attributed to crypto mining. While crypto has been exploding around the world, miners' lust for GPUs, particularly Nvidia's, who've proved to be anecdotally the most effective, have continued to explode. AMD has also benefited from the GPU craze, but they aren't nearly as dependent on GPU sales for their growth as Nvidia is. When asked about this question, Nvidia basically said that while it's hard to determine an accurate number, we estimate somewhere in the range of 1 to 2% of our GPU sales can be attributed to crypto mining. I personally feel that's like extremely understated, and I wouldn't be surprised if it was something closer to like 15 to 25%. And back in 2018, after the last crypto boom ended, we did see a downtick in Nvidia's GPU sales of about 12% in 2019. So it's not immaterial, and it's just something to keep in your mind. Interestingly though, GeForce RTX 3080, 3070, and 3060 Ti's Ethereum hash rates will be reduced. They're branding this as an LHR, or light hash rate, to deter miners for the benefit of gamers. I think that's a really smart move, and it shows that Nvidia, while they're benefiting from the whole crypto boom, they want to keep gamers at the heart of their business, and they realize that's their core. Either way, this $2.7 billion number up here makes up almost 49% of the company's revenues. Nvidia has been massively hard hit by the chip shortage worldwide, and I suspect that will continue moving forward for a while, as chips generally take like a year to make as they go through the supply chain, and chip making foundries aren't something you can just slap together in a couple of months or weeks either. On that chip making shortage, there was a bill presented in the US that could massively aid the ongoing problem brought on by the pandemic and the massive shift to working from home. If you want to learn more about that bill and how it could change the game, please check out the link up here and down in the description. Having half of their revenues from gaming isn't new for Nvidia, as the chart shows us, but it's key to factor in the whole crypto boom, as well as other competitors' bang for buck options appearing when considering this growth going forward. Quick note on other items here, auto includes Nvidia's Drive PX platform, which is growing in adoption and could eventually end up being one of, if not the, major player in self-driving in the future. As far as I know, it's not quite on par with Tesla stuff yet, but for most other automakers who aren't software companies like Tesla is, at the same time, outsourcing deep learning like this to Nvidia could work out to be a great choice. 370 partner companies are using the Drive PX platform, so while the auto segment of Nvidia is like very dinky right now, if we see this ending up in lots of different vehicles in the future, those numbers could change quickly. Next, looking forward at expectations for the coming quarters. Nvidia, being conservative, loves to surprise the analysts who apparently don't really know how to value semiconductor companies at the moment, as we're seeing, with other companies like AMD and a bunch of other companies actually that I'm going to mention here in a minute. Nvidia is expecting revenues to jump from 5.6 billion up to 6.3 billion, which again, if we factor in how regularly conservative they are, should probably actually end up being something like 6.7 billion in reality. They're also expecting GAAP margins to continue on at their typical 64-ish%. We're here at April 30th, 2021 actual, and looking forward, it looks like they're expecting strong revenue growth going into 2022, but it appears there's a sharp drop after that, which is where the alarm bells start to ring for their current evaluation for me. EBITDA shows a similar story where they're expecting negative year-over-year growth as early as next quarter, which gets bigger into the coming quarters, along with decreased margins. What's the deal? I don't know in particular what they're expecting, but sandbagging aside, this is like pretty alarming. Let's also take a look at how some of the metrics stack up against competition to get a good idea of how they're valued in the market too. Check it out here. We have EV EBITDA, price to sales for the trailing 12 months, and price earnings for the trailing 12 months. We see Nvidia far and above all competition on, I think, all of these metrics. But if you go down the list, we have AMD, Intel, Taiwan Semiconductor, Texas Instruments, Marvell, Micron Technologies, and ASML. And I realize that these are kind of not necessarily just competing with NVIDIA, particularly in GPUs, but they're kind of all in similar segments. So it's interesting to look at the numbers and compare them to kind of figure out, how things are pricing out. But simply just looking at these three kind of key indicators, key factors, and ignoring potential for future growth or decline, it seems like NVIDIA is really overvalued. In this quick little video linked up here, I break down EV EBITDA ratio for you if you're unfamiliar with it. But it can be a good tool to compare businesses in the same market to get an idea of whether share price is overvalued or undervalued. I understand that some of these companies aren't direct competitors, especially in the gaming space, but looking at a broad stroke of kind of the whole market can provide some scale for us. Also, a lot of you guys keep asking me to look at some of these companies like ASML too here. So when we compare these numbers with the competitors, it's easy to see that maybe they're probably pretty overvalued. And the problem when valuing the company is that while they do continue to consistently beat expectations, the market expects that. And when the market expects that, you're going to be paying a premium for the stock. Now, if we multiply the last 5 years historic EV to EBITDA ratio of, let's say, 38 times by the expected EBITDA of 2022 of 8.1 billion, we arrive at an enterprise value of only 309 billion, which sits far below the current enterprise value of 387 billion. That EV to EBITDA multiplier is super up for debate, as many valuation metrics are, but if we do indeed end up seeing even a slowing of growth, let alone negative growth, Nvidia's stock price could plummet big time. So while it's obviously a healthy company, I'm not super pumped about buying in at these current prices because of that risk. Let's also take a moment to look into some of the other risks investors in Nvidia should consider. As mentioned earlier, the whole GPU craze is obviously the biggest one to consider, but another big question mark on the horizon is the ARM acquisition that Nvidia has been working on. A $40 billion acquisition of the mobile chip designer from Japan, SoftBank, in hopes of strengthening Nvidia's position in AI processing. This deal has been vehemently opposed by large players, including Microsoft, Google, Qualcomm, and others, prompting the Federal Trade Commission's investigation. Some analysts are expecting less than a 50% chance of the acquisition to go through. That's a big risk factor to consider, assuming that that deal's completion has already been priced into the stock price. On the other hand, who knows how wild the multiplicative benefits will be for Nvidia should the deal actually go through. The next one's not necessarily a risk factor for current holders of the company, just a factor to consider for the short-term horizon of the stock price. And that's the 4-to-1 stock split that was recently announced, especially if we see the Apple and Tesla effect coming into play, which could potentially bump the price up even more. Now, it doesn't really make sense to value a 12-inch pizza at the price of a 15-inch pizza just because you cut the 12-inch pizza into the same number of slices that the 15-inch pizza has. But newer investors just get excited when there's a stock split. And that happened with Apple, that happened with Tesla, and we did see material gains in the stock price. So that could happen with Nvidia, and that's good for current stockholders, but it could potentially overvalue the stock price even more. And you get that whole like rubber band effect. The more overvalued something is, the more resistance there is to more stretching, and the quicker things snap back when released. And so just keep that in your mind. You know, if we see the price go up, significantly after a split, should it end up going through, keep that in mind. Another risk factor to consider could be inflation. There are daily debates about whether or not real, tangible, lasting inflation is actually coming, and the Fed insists it isn't, but I personally think it can't be avoided. And historically speaking, chip makers are usually not really beneficiaries in markets with big inflation. You take the combination of a squeezed supply chain at the moment and combine that with rising price of gadgets, and it gets hard for companies like Nvidia to boost their prices in a commensurate way without losing sales or offending customers. That being said, we do know that Nvidia does hold a premium slot in the market for both graphics cards and data centers, so it's hard to tell how much this will affect them, but it is a risk factor to consider. So, personally, like I mentioned earlier, I'm not super into Nvidia's current stock price based on the valuation, though I would be if we saw big dips and the ARM deal end up going through. I love the stock and the company and would probably recommend current investors continue holding on for a bit, but it's hard for me to strongly recommend new investors get in now. Depending on what happens with the ARM deal vastly affects my price targets too. But let's just say we're way out of range of the prices that would get me to buy in right now. What are you doing with Nvidia? I'm looking forward to hearing your thoughts down below. And if this was helpful, please take a moment to leave a little like for me. Please also check out our growing playlist of chip-related companies as well. Love you guys, and don't forget to stay generous.